Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City. I was at an investor meeting a few weeks ago in San Francisco, and I've been doing this in San Francisco for the last 11 years. And, I get all sorts of questions fielded from the audience or at my table after I speak. And, people will come up and they'll look at my spreadsheets. And one particular incident really kind of always intrigues me. It's when somebody comes up and they're a little bit dismissive and they say, well, something, it's got to be 1%. Now, what do they mean by that when they say 1%? Well, it's kind of a similar kind of thing of saying somebody wants a 10 cap. So they're saying that, well, if that house is 1,800 square feet, then I want $1,800 a month. Well, on paper, just that simply, that sounds really, really good. So why would you buy something in Oklahoma that's 85 or 90 cents a square foot as versus $1 a square foot getting that 1%? Well, it's very simple. That's the tip of the iceberg. And that's what I explained to the gentleman. He's about to walk away. And I said, excuse me, sir, will you come back here for a minute? And he said, well, okay. And I said, so you'll buy anything on a 1%? And he said, yeah. I said, well, I tell you what, let's take that 10% differential between the 90 cents and the $1. And let's put that house in Texas. It's versus Oklahoma. That's one example. I said, our taxes are pretty well based on 1.12% of value, where in Texas it's 2.5%. It's typically at least double or more the property taxes in Texas than it is in Oklahoma. So, does that affect the cash flow after everything is done? He said, well, yes, it does. And I said, okay, so let's say you're an area that's affected by flood or affected by hurricanes or whatever. Let's say you're on the coast in Jacksonville or around Orlando or whatever. But I don't know Florida as well as I should. But essentially those coastal areas. And let's say that your insurance is 2 to 3 times what my insurance is in Oklahoma. Wouldn't that affect finally the cash flow of that 90 cents to $1 comparison? He said, well, yes, it does. And I said, well, let me do one final thing here. Let's say, for instance, that the HOA somewhere in Florida or Houston or wherever it happens to be is $50 a month. Mine's $10 a month. So there's just $40 a month right there. Wouldn't that affect the cash flow of the 1%, the $1 a square foot versus the 90 cents a square foot? And he said, well, absolutely it does. And I just made a suggestion to him. I said, look, here's a sheet on the price range that you talked about. Look at that cash flow. Go somewhere else on one of these other tables from one of these other markets and just see what the final results are. And he did. And he came back and said, you're correct. I looked at yours that was $335 a month positive cash flow. I compared it to one from another city that was $125 a month in terms of positive cash flow, and they were getting $1 a square foot. And I said, well, that is my point, and that's my point to all of you as an investor. I'm not telling you that Oklahoma City just smokes every city in the United States on investment or that you should buy everything in Oklahoma City. What I'm cautioning you is not to use cliches. Don't use the 1% rule when it doesn't necessarily apply to final cash flow or an internal rate of return over the time that you own that property. There's other factors I don't have time to talk about, like maintenance, being more maintenance-oriented in a 20-year-old home versus a 2-year-old home. But look at all the details, get all the statistics, get all the return on investment analysis that you can before you do something like that. Same way with a cap rate. I saw one that said it was a 9% cap rate, and basically the way that I would evaluate that cap rate, because I put the kitchen sink in there, vacancy, maintenance, a lot of things, it was actually 7.75. So understand that you need to be able to talk to somebody also that understands return on investment and is giving you honest statements. So don't go on these cliches that you might get from some seminar that's going on around. The really essence of the situation is 2 things. Are you getting positive cash flow? What's the risk factor to that investment? Are you getting a lot of vacancy? And over the course of time, what is their best return on investment? The devil is in the details. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.